afternoon, everyone. I hope you're well. It's Friday, Black Friday. Presumably, you're all either all out shopping, or you're all online, or you've done all your online shopping. Who knows? But Black Friday, it's not just Black Friday anymore, is it? It's the Black Week, as some people call it, or Black Shopping Week, and then there's Mondays, Tuesday as well. All sorts of things going on over this key weekend. So obviously, Advent starts for many on celebrating Christmas on Sunday. It's St. Andrew's Day tomorrow, the 30th, the end of November, end of the 11th month already. But yeah, lots going on as ever. Well, not a great. I'm saying lots going on. Not a great deal going on. Obviously, US markets are open now. They're opening. It's a shortened day, as you can see here. Well, I hope you can see this. Is the 5-minute chart on the S&P 500 stock market. So we've been. We take this up to the bit of volatility, obviously, on the open. We take this up to the 1 hour. Let's start with the 1 hour chart today. Click log. So strong move this week. Again, all-time high 6,030, around about 6,030 level, wasn't it, on an intraday basis there on the 27th on Wednesday. Close lower Wednesday. Obviously, we weren't open yesterday. This is the futures market. So the futures market yesterday and again today, the derivative market has sort of drifted higher. It's a slight trend here on the hourly chart, but you can see the big candles were biased really to the downside, and that's sort of what's happened here just ahead of the open. So the hourly candle is short here in this shortened day already, and we're going to go through today as well. I'm going to go through 3 very simple, anybody can apply trading strategies. People are always asking me all throughout my career. People have asked about trading strategies and what's the best one, what's the best time to trade, what's the best asset to trade. Sorry, let's get rid of me. And really, it's not about the strategy, because strategies, you can find them for free. Obviously, I've paid for them in the past. I'm sure a lot of people that have traded before will have paid for advice, or paid for an EA, or paid for some guru, paid some money for some course, weekend course. I remember paying thousands and thousands years ago for a weekend course of some guru, some Cockney wide boy he really was, but he talked a good game. But you can't beat doing it yourself to understand yourself, because that is the absolute pinnacle of success in trading, is understanding yourself. If you're going to trade a time frame that doesn't meet your psychological needs, doesn't fit with your psychology, your physiology as a human being, you may as well go and do something else. However, once you find the thing that works for you, and everybody can, people give up too quickly because they end up risking too much and blowing their account and thinking they can't do it and giving up. Persistence pays in all sorts of forms of life, and trading's no different. Doctors don't become great doctors overnight. They train for a long time. They go to university, they go postgraduate development, they junior doctors, before they make it. Pilots, they train for many, many years. Anybody with anything about them, lawyers, solicitors, good traders, they need the trades under their belt. They need some time and effort dealing with it. But there's nothing quite like trading, because we're dealing with money. If you're using your own account, you're dealing with your account. If you're working for a prop firm, a trading firm, a bank, trading, an hedge fund, insurance company, managing other people's money, it's a different sort of pressure. Do you like the new T-shirt, by the way? Hope you do. There we are. Just got that yesterday. We're going to get some more. I look particularly sexy, I think. But anyway, we'll see how time goes on. But welcome. T-shirt in the middle of winter, but it's nice and warm in here. But anyway, back to the charts, back to you. Yeah, and that's what I'm going to show you today. So it's not the strategy. These strategies work, and they work well enough. The problem is people applying the strategy, traders applying the strategies, or teams of traders applying the strategies and not following the rules, jumping in before the candle's finished, deciding not to take the trade and then regretting it, or taking a position that's too large. That's usually the problem. Risking too much and not accepting when it goes wrong and getting out, and accepting their stop loss, moving their stop loss down, or moving their stop loss up as the market goes against them. That's absolute class. And we've all done it. I've done it, and I'm sure you guys out there will have done it. But we'll go through three simple strategies once we've been through the markets as they stand, because we're wrapping up obviously the month, not only the week but the month as well. So let's have a quick review of everything before we jump into the strategy. So we'll be around for about half an hour, 45 minutes today. If you want to skip, if you're watching this later, if you want to skip through the first bits, and I'll get to the strategies in about 15 minutes time, I would guess, maybe a bit before that, so you want to skip forward. So let's just run through some of the major markets. So the S&P 500 has opened so far down. I think it's down. Yeah, well, we opened here this 5 minutes ago. In fact, we bounced up. We were down before the open. We've bounced up in the last 5 minutes. So, but we're moving basically sort of sideways, you'd argue, wouldn't you? Today, having rallied. Let's go back to that. Sorry, let's go back to that 1 hour. Just stay with the 1 hour charts as we're looking at longer term, the like end of week, end of month. So gentle rally yesterday in the closed session on the derivatives market, and a gentle rise today. We're shy of the all-time high of 6,000. We are still holding over the hugely psychological 6,000. So it'll be interesting to see where we finish today. It's only 13. We're only 13 points above that at the moment. If we hold 16,000, I know I'd say this all the time, but these round numbers do count going forward. So hugely psychological. If we go up to the daily time frame, you see what a strong month November has been. Principally, obviously, thanks to the incoming president and the expectations of what he might do for business, particularly the Bitcoin market, but more on that in a minute. But stocks have done remarkably well as well. So we topped on the 11th of November, so a week after the election, at 6,000. Over 6,000. I should put this, there's about 6,000 level here. Then we slipped a week later, and now we've rallied again into month end, holding the 6,000 level. So the trend remains set. This is going back to April. Let's go to actually it's a daily chart, isn't it? So we can see here. This was the beginning of October. We were back down here at 5,700. Beginning of the month, we actually slipped into the end of October, so we were under 5,000. Actually, we held 5,700. Yeah, 5,700 beginning of the month as well, and here we are at 6,000. So it's a good gain, 300-point gain, new all-time highs. First test was we moved down from it, so big up leg. Following week down, and the final week, this final 10 days of November has been positive, and we're consolidating at highs as we go into November, and that's a positive situation. So going forward, the big support for me on the S&P is there at 5,950. That's the line I'll be watching as support as we go into the year end for the S&P 500, similarly with the DAX and the Nasdaq 100. So the Dow has opened again, created new all-time highs on Wednesday at 45,000 level. Huge numbers, and you see here on the daily. Similar pattern to the S&P 500 you might expect. Big rally on election day. Follow through the following day. We spiked. We topped on the 11th, then moved down, but we've moved higher. As you can see, we've moved higher here for the industrials, the 30 industrial. Big industrial companies that make up the Dow 30 have moved higher than the wider 500 broader based S&P 500. So the Dow, the industrials seem to be doing better with the expectation that the Fed rate cuts might start to slow down. And therefore that's you can see how it's impacted the Nasdaq in a minute, but because the IT companies, the high tech companies, are more vulnerable to interest rates than perhaps the more established industrials that we see in the Dow. That's really differentiates the move of between the Dow and the Nasdaq. They're also the different way the indices are weighted as well, and not all three of them are weighted the same way. So it's how they calibrate and how they're put together. But anyway, that's minor technicals. As far as the trend is concerned, the trend is very much your friend and you're online. So again, we saw the big 20-day moving average much lower than the price action on the S&P 500. Similar here for the Dow, 43,950 is where our line in the sand going into December lies for the Dow. And similarly, the Nasdaq had a good November, again topping on the 11th, retracing for a week, and then again, as we've said during the last 2 weeks, the 20-day moving average provided a really nice support area. Not recovering as much as the Dow or the S&P 500, as I say, because it's a bit more vulnerable to the slowdown in the anticipation of the rate cuts from the Fed. So again, the 20-day moving average here for the Nasdaq is much closer than it was for either the Dow or the S&P 500. So this one's a bit more vulnerable to a turn down than the other two. Looked like we were going lower here on the 15th. That didn't happen. Short trade didn't work out, and we've gone long. To be honest, as we go into month end. Say very shortened day today, lots of low volume. There are people at their desks in New York. I spoke to somebody earlier actually in New York that was actually working today. It's very very ticked off. But he's ticked off, but he'd volunteered to go into the office, so I can't give him much sympathy. But anyway, it's a friend of a cousin of mine. In New York. So there's the US markets. They've had a good November, supported by the clarification of the election. The other thing markets don't like, the biggest thing that markets hate is uncertainty. So the clear victory for Trump, whether you love or hate his politics, the markets, don't really care in that sense. They just want some clarity about what's going to happen. He's been very clear about what is going to happen. He's been very clear in the appointments he's made about his policies, his economic policies, his political policies. Obviously, and say whether you love him or hate him, it doesn't really matter as far as making money is concerned in the markets. You react to the situation. So the 20-day moving average has been our friend. It's been my friend for many, many years. The 50-day moving average even more so, the blue line here. And so you can see here clearly the trend is moving, and we're going to look into trending strategies in a minute. Let me just quickly run through the others as well. So that's the major indices. Crypto, I'm just going to pick on Bitcoin back to the 97.50 500 level. So tremendous November. I don't need to explain to you why. We've had a massive rally here, 45% rally. 100,000 seemed absolutely inevitable, didn't it? This huge candle here on the 20th. It looked like we were just going to charge through it. Well, the markets didn't do that for us. We stalled within a smidge of 100,000. We've had 1, 2, 3, 4, 5 consecutive down days. We've now had 3 consecutive up days, including today. So it does still look like 100,000 is inevitable. And if you put your, your long-term hat on, if what Trump is suggesting happens, 100,000 will look like, what 10,000 looked like, or what 63,000 was looking like early in this year, and where 10,000 was and 25,000 was a few years ago. Remember 2017, my friends, we could see another big move in 2025 for Bitcoin as the leading cryptocurrency. But I'm not in the market of predictions. I'm in the market of following rules. And again, here you can see the 20-day moving average has been your friend since the break here. Significant break. Well, the first initial break here is the 8th of October, but you can see we were still going sideways. Nothing was really happening. And even on the initial break here on the following couple of days on the 13th, it wasn't until we broke through here, and we broke through this level here. Really, it was this day, the 28th, and then the election day itself, where we burst out of this consolidation here. And off we went, 40+% rally for November 2024 for Bitcoin. Yeah, it's like 2017 all over again, isn't it? So anyway, so Bitcoin on the front foot, 97,500 this morning, and we're up for our 3rd consecutive day, having been down for 5 consecutive days. Don't you just love trading with Bitcoin? The major currencies, not a lot going on. We've had some data. Let me share the calendar this morning. There was the Canadian data. Obviously, the Canadians are still at work, well, like the rest of us. So many Americans are celebrating Good Friday, Black Friday. So we have some inflation from the CPI data from Europe was a bit well, it was in line with expectations around the at 2.7, the overall number. Some details were a bit weaker, but again, it's proving this, as we said earlier, it's proving the stickiness. It's it's not going away. As you can see here, the 2.3%. It's in line with what was expected, but it's up from where we were last time. The core, the more important core, 2.7, even hotter. So that's pushing the euro. It's pushing Lagarde and Co. To look to push to cut rates again in December, which looks like that's definitely happening. So looking forward, they may have to be more aggressive in the Fed. So there's possible diversions in outlook from the central. So the other major news of the day really was the GDP, the monthly GDP numbers out of Canada. But as it's a monthly number, it's it's only two bulls here on this investing.com, and I think it's a similar on other calendars as well. But more or less in line, better than expected, in some technical readings of it. But yeah, there we go. New month starts on Monday. More on that next week. We kick off with Chinese PMIs on Saturday as well. Lots of stimulus still required for the Chinese economy, but there are signs of green shoots of recovery. And you see here but only just over that expansion phase for services and manufacturing PMIs out of China. But more on that next week as the rest of the countries report their PMI data. So let's go back to the charts. Look at there. So Bitcoin was up. Let's have a look at the currencies, and then we'll look at the strategies. We'll have a look at gold, and then we'll look at the strategies. So let's quickly just euro, pound, and yen. Unless somebody wants to look at something other than those three majors, let me know, my friends, on the chat box. So euro daily time frame, like with the others, it's been under the cosh. Remember that intraday low we got to towards the end earlier this last week, wasn't it? Yeah, 103.32. Leave that on your charts, my friends. That's still in play. We've recovered from there quite significantly. We're back over 104. We're back over the more important 105 area for the euro into month end. But the trend, as we say, is your friend, and it's still down, isn't it? There's the 50-day moving average. There's our 20-day first break back on the 1st of October, and thank you very much. No way. See what's happened there? Little retrace, big candle down, new low from the low of this little group here. That was very bearish, and down we went, down we went, down we went, down we went, under the 105, under 104. And even under sort of under 104 on an intraday basis. We didn't go under 104, sorry, correct me, under what the key 105, but we recovered the 105, unsurprisingly, buyers at that level. But yeah, but the 20-day moving average is still yet to be breached on an end of day basis. And the last time the euro candle closed above its 20-day moving average was back here on the 30th of September. So we've been down for October, down for November. We might turn around in December. Who knows? Who cares? I don't. I'm just following the rules. I'm still short, and until the strategy tells me otherwise, and we'll look at how to play the strategy in a minute. Okay. Sterling, similar sort of battering from the return of the dollar. This was again back at the beginning of October. Down we go under the 20-day moving average. It's held. It's held. It's held. It's held under the hugely psychological. 125 again, just on an intraday basis, but we did breach it. That's the one to look, that low there, 124.86 for cable. We've turned around since then. We're back over 125. We're back over 126. And today, interestingly, we spiked over the 20-day moving average, but just on a intraday basis earlier today, 127.50 we went to, which is some interesting, I would say. This is looking to perhaps go long, as you can see here. We're tracking here, but we need to break over the 21 for this strategy to go positive. It's still well, it's not short. It would have taken us out there. We would have on an end of day basis. That would have I'd probably had it around now. Would have lost out. It closed out there on the turn. And I'm going to explain all that in a minute, how to use this actual setup was one of the ones we're going to have a look at. Okay, so cable, dollar remains on the front foot against the euro. It remains on the front foot, and it's still on the front foot against the other major currencies as well. Aussie continues to pivot around .65. We're stuck right on it as we speak. Dollar CAD is back over 140 from over 141 earlier in the month. So there's our 140 level. So again, another one that's consolidating at highs. Another one, as you can see, the dollar's really benefited here against the Canadian dollar. Weaker oil hasn't helped the CAD either, but this has been going on again, a bit like the others. A stronger dollar, even though Trump's talking about a weaker dollar. We shall see how it all pans out. And finally, for the currencies, yen. Turning around, unlike the others, on a stronger yen, and not necessarily a weaker dollar, but a stronger yen. So dollar rallied through 155. We got as high as 156.75. Middle of November. We've then turned around as the yen's come back into play. Dollar's weakened against the yen in particular, and that has actually turned short here on the 26th, followed through 27, 28, and we're down again today, 29th, actually under the 50-day moving average. So the yen is very much in play this final week of November. We've had a really nice run. That run is now over, as we said earlier in the week, as we broke the 20-day moving average. Couldn't hold in that channel. Remember, we talked about the channel, the 54, 53 channel. Sorry, that's 52 channels. No, 54, that's right, 55 and 54 channel that we broke out early in the week. And when we broke, it broke really aggressive. If you weren't with us, let me just show you the what we were talking about on the hourly channel. If we there we go, and you see that like auto. It's a bit, zoom it in. You can see we were in this channel here. The 155, 154, but we breached it, and we breached it significantly. Went back to it, didn't, and then we created a new low here on that candle there on the 26th. We remember mentioning it on Wednesday, as it's not Wednesday, it was Tuesday, wasn't it? As it actually unwound significantly on that 12 o'clock candle, and we rallied down again. See how the big round numbers into play here. This is the hourly chart this time into 152. Didn't want to breach it. So that's a sign of weakness, consolidation, and then down we go again under a hugely significant 150 level, and there we've consolidated during Thanksgiving and all of today as well so far. So dollar yen reversing the trend compared to the euro and sterling very much still under pressure. The yen's come back against the dollar. And finally, we'll have a look at gold on the metals, unless there's some other crosses you guys want to have a look at. Let me know. So gold from earlier in the week, from looking like we were. Let me just go back to the daily chart for the. As we said yesterday, I mean, it's had a great run, gold. Or it did have a great run. And we were actually down for November on the strength of the dollar. So let's take us back. So this is for November here. So this is the 1st of November here. Oh, that's the last day of October as we've gone to that 279 area, and we've had a week. November lost well over 4, 5, 6% at one point as we went under the 2600 level. And it looked like we were potentially targeting that level as well. As I've written here, the late 2605 was our intraday spike lower earlier this week, and we sort of anchored high. But see how the days up have been a little bit inconsequential compared to the last big rally, and also the huge shakeout we had on the 25th. That was a politically driven, people were selling gold, having had a really good run for October and September, and most part and start to sell off in November. The ceasefire with Hezbollah and Israel sort of took out a bit of the geopolitical bid on gold, but that's far from over. Obviously, the global geopolitical situation still looks very fragile. He's had little to say about North Korea. President Trump's more at the trade and his immediate allies, but you know, the situation is still ongoing. I hate that phrase, but it's ongoing situation around the world, isn't it? So gold will always have some sort of buys, but massive sell-off earlier in the week, and the retrace has been relatively weak up until today. But remember, today we've got very thin markets, so don't get me caught out by moves up on little volume. Even though we are testing a 20-day moving average at the moment. But yeah, we've had a nice bounce. It looked like we were potentially going lower if we broke the 2600 level. That didn't happen. And we recovered sort of the best part of $50, and we're currently trading at 26.55. So we're having a better day today as well. But it's been a relatively weak month. We're down about 4% on the month thus far, about 3% at the moment. We'll see how that market closes later on today. Okay, so if there's no questions or other assets anybody wants to have a look at, I'll move on. Let me just bring up my other system. I meant to share this on this platform and I didn't. Sorry, I apologize about that. I'll do that next week. Let me just see what's ticking on my live system over here for trades for potentially tonight on Friday close of business. So I've only got one on the forex market, and that is the Swiss. Sorry, that's the Kiwi against the Swiss franc. Let me have a look at what that looks like first before I'm sure. Yeah, stop loss. It looks stop is about 35 pips at 51.82. And target 52.69. It's at top of the range of where we've gone. Let me just show you that potential trade. It's an end of day trade potentially around the Swiss yen. So let me just crosses. What did I say it was? Kiwi yen. So NZD Swiss franc. This is an end of day potential end of day trade, i.e. the end of tonight when the market's close, an end of day position. As you can see, it's very, very much range bound, so it's not really a trend following strategy, but it's looking to perhaps go long with a stop loss at 51.82, so just below here. It's around about this level. It's just below the line here, and it is a strong day. That's why I understand why understanding my system, I understand why it's triggered. But the 4 hours probably already gone. We apply the same. Yeah, so the big candle here, that's why my system's getting twitched. Excuse me, looking to go long from this morning. So, and it's positive at the moment. This might all come back before the day's over, so this might not trigger on the close of business tonight. So there's only one position that's looking to go there, and that's this one here, the Kiwi Swiss on an end of day basis, and more aggressive strategy as also the Kiwi New Zealand. No, this is New Zealand Swiss. It hasn't got that. It's got Euro New Zealand. Is the other one. So New Zealand day, even though they're all asleep down in Wellington. Yeah, and again, you can see why that's triggered on the 4 hour basis. It's trending lower. So the end of day basis, and again, that's been short since then, and it's, to be honest, this strategy is not the one I'm talking about, but it's been short if you've held it all that length of time, because it went sideways and now it's gone lower again. So you're out of the money all this time here. So from here, 10 o'clock on the 26th, you're out of the money until just this morning. Whether you'd held that sort of trade all that time, I don't know. I probably wouldn't have done Euro Swiss Kiwi, but it's going lower now, and it's looking to trigger on the daily time frame as well tonight. There we go. So it's pushing new lows. Interesting. Yeah, that's looking more likely than the one we had before. So Neuro New Zealand looking to go short tonight as well. So check that out later on tonight, my friends. Okay, right. Let me just check my question box, my chat box. There's nothing in there. Okay, hopefully you're all still with me. How long have I been blethering on here? Half an hour. Okay, so let's run through some strategies then. Okay, so there's lots of different charts on here. Trading View and Trade Locker. Nice packages, simple to use. Let's get rid of the markets panel for now, so you can see the whole screen. Okay, so this is hopefully you can see load layout. Okay, so these are some layouts I have set as default, and we're going to go through 3 of them. We're going to go through this crossing EMA strategy, the 5, the 9, and the 21. We'll have a look at the MACD and SAR. I like that one as well. And we'll probably have a look at the Heikin Ashi candles, and I'll explain Heikin Ashi candles and the ATR strategy as well. So these first 3 strategies and how to use them, where the stop loss, where the target might be, and how to apply them on different time frames. Okay, so first up is this one, the exponential crossing strategy. Okay, it takes the form of 3 moving averages. Hopefully you can see here. So to apply it, actually, if I what do I do? Let's open a new rename this one to actually cancel it. So open a new, load a new, make a copy. So we call this blank. We'd go from blank. Okay. So if we then remove, let me just search maximum chart layout region. Okay, never mind. I won't make a copy. We'll just use what we've got. Okay. There we go. You learn something new every day, don't we? I've got enough, so I can't do that. So cancel that. All right. So let's zoom this up and we'll look at the markets that are on here. Let me just take the 50 off it because it's not one that's actually applied to this. Okay. So this has 3 moving averages here, and it's the 5, the 9, and the 21. So these are exponential moving averages. So to put them on your chart, you simply find exponential, so EMAs, moving average exponential. So if you click that, the way that TradingView is defaulted, it automatically puts on it defaults it to the 9. So to change the parameters, you simply click on the little 3 dots there when you go on the actual strategy. So it's got 2 lots of 9 on there, and you go to settings. So click the 3 dots and how you want it to look. So you can change the color of the line, change the width of the line. Let's make it a yellow one. Inputs, and this is the length of the exponential moving average. So 9 is the middle one, and that's the 9 period, and that's the one the one we use. That's sort of the midline is the 9. Okay, so it's very, very easy to input on TradingView and on Trend Locker. So if I remove that, take that off because it's already on, because you can put it on as a cross when you install, when you look at for exponential EMA cross. You see it defaults as a 9 and 26. So you just amend that if you want to use that. So if you want, you can use there 26. I use 21 instead of 26. The numbers don't matter too much. I've used 5, 8, and 13 before, but I quite like 5, 9, and 21. It's just a personal preference. All of them work and work well enough, guys. Don't get me wrong. When the markets are moving, let's take that off. It's just a matter of how you manage the trade, the size of the position you take on, and you know, how you deal with it emotionally when you're winning and when you're losing. That's what differentiates winners from losers. So basically, we have 3 moving averages here. So we've got the fast moving green, which is the sorry, hang on a minute. How is that set up? So I've got these settings. So 5 and 9 style. So orange is the fast moving. So that's the 5. The green line is the 9, and the blue actually puts the cross on. If you want the cross on, some people don't like having it on there. So when they actually cross, okay. So that's what's happened here. This is the cross of the moving average here. So this is a potential long trade here. Okay, so the 5, the faster moving moving average is crossed above the medium paced moving average. So the 5 has crossed from below to above the 9 period. And if you were just using the 2, you'd have gone long on the end of that candle. Okay, it so happens that on that day there, the 4th of October, this particular asset, Euro New Zealand, as you can see, has also crossed the big fat magenta line, which is the 21 exponential moving average. Okay, so that has gone long on this day there at 178.17. So that's a long position from that line. Horizontal rate there. Okay, so we use exponential moving average on the anything below the daily time frame, because it's a bit more, not much. You can use simple moving averages, but I actually use exponential moving average on this one. Okay, so that's the trigger to go long here on the 4th of October. The stop loss and the target now depends on how you want to run the trade. Okay, there's various ways of doing it. If you're being very, very conservative, the stop loss should really be where the market has turned, because what moving averages are showing you is a shift in the trend. Okay, when the 5, the 9, the 21 are all in unison, they're all in alignment, they're all in the right order. So we got the 5, the 9, the 21 here in alignment. So we got 5, 9, 21 in unison. That's a positive, nice sort of trend, as you can see here on this move up here. So we were flat here, and then we've all moved up nicely here from the 23rd here, 21, 9, 5, as we move up. So our entry here and our stop loss, again, if you're playing it very, very conservatively, would have been all the way down here on the turn of the market. So that's our potential risk reward ratio. That's our risk that, as you can see, we didn't move up that high initially anyway. Okay, so if you want to be very conservative, that's where your stop loss would be. Alternatively, this is not a great example. I would count, back, say, 3 candles from the close. So it hasn't moved it that much, has it? So that's our entry. 1, 2, 3. That's our close. And that's our stop loss. So we then open the trade at this point and let the market run. So we set a stop loss. And again, the beauty of a trade locker is, if that's our entry and that's our stop loss, we can put those levels in. And if what we want is that this loss, if this actually turns around and hits this initial loss, I would put this. Let me bring the order panel up. Let me smooth this out of the way. There we are. I would put this, let's say ideal risk. Well, let me do this because it's let's say 2% of my. Whoops. So we put 2% of my 2%. You feel 2%. There we are. My stop loss is here at 175. I don't know if it'll do this because they're like 175.55. So I can put that. Stop loss at 175. 55.17. So we can actually 175.17. Obviously, the price is just around there, isn't it? So it's a similar. Obviously, because the price is coming down, it's a. I won't be able to put that. It would be my target, wouldn't it? And that's how you can determine how big a lot position you'd want on there. If we need to put a sell. No, that would have been my target, wouldn't it? Oh no, we can still do that, can't I? Because I want buying, so that the price is here, so it will work because that's my stop loss. So my stop loss is here. For one lot, I'm only using. I'm only going to use $16. However, if I put a risk level in here now, and I'm risking say 2%. Whoops, two, you fool. It tells me I'll be able to use 1.2 lots. If my stop loss is here, I'm risking $200. 2% means I can trade a lot size of that. You don't need to worry about what the lot size is. That's actually worked out quite nicely because of the price, the live price being in there. So that's our stop loss from our entry where we are now. And you see the entry is the current price, which is round about sort of where our sort of trade last triggered on this particular our example triggered here. Okay, that's the beauty. That's one of the big benefits of TradeLocker, being able to work out exactly your the risk level. If you're feeling a bit a bit more aggressive, 5% means we can trade 0.3 of a lot on this account size, which happens to be sort of $10,000. Okay. Alternatively, instead of putting in a percentage, I always prefer, as I said yesterday, percentages, they are numbers, but they feel less sensitive than actually saying, I want to lose, $200. That's the maximum I can cope with initially. $200. So you're risking less than 2% if you lose $200. So that's okay, isn't it? However, if I'm being really aggressive, I want to risk. I think I can risk $500 on that, which is about 5%. But it means I can trade 0.3, virtually 0.3 of a lot, a third of a full lot on this position with my stop loss here, with the price here. Going to the upside. Okay, so that's one of the big benefits, in my humble opinion. I've looked at lots of different platforms of TradeLocker over sitting on the TradingView platform. TradeLocker, a really nice, intuitive sort of platform. So just move that out of the way. Anyway, let me just close that out for now. So that's so we've said whatever it is, our percentage stop loss, and then just let the trade run. See where we get to, see what target we get to without well, if it's a trend, it should keep going until it doesn't keep going. Okay, and how do we know when it doesn't keep going? Well, it's when the moving averages then cross again, as you can see here. So we've got in here, we've moved up for the first 2 days, really aggressive. And first 2 days, we're all like, "Hey, that's great, we're in the money. It's easy, this trading game." Next 2 days, we go down. Third day, we go down. A fourth day, we go down. Finish about the same place we've done on the third day, and we might be saying, why didn't I close this earlier? Well, because the rules haven't broken. We haven't broken under any of the key moving averages that we're playing with. One way of running this market would be to get out when it closes under the medium moving average. So remember the green line. So the green line is the medium moving average. So we would have closed out if we were running it on this first strategy. We would have got out at this point here. So we'd have got out. So it hasn't made great amounts, has it? We've when it's crossed under the. There we are. It's crossed under. So that's our profit. Although it's gone all the way up here. In fact, it's gone all the way up here. We'll give all of this back. That's one of the problems with the strategy. However, it is a winning trade because it's crossed under the 9-period moving average. So that's the first way of getting out of this trend following strategy. So we enter when the moving average is crossed going up, and we get out when we go back under the medium pace moving average. The other way of doing it is to look at one of my other favorite indicators, which is the ATR. Okay, so we can work out what the ATR was when we got in as well. And I just put that on there. Wasn't right. It was here, wasn't it? So the ATR, which is the average true range of this particular asset. So how far does it travel? Well, typically on a daily basis, on the day that we got in on this candle, or the hour we got in, or the 4-hour time frame we got in, what was it? Well, it was 0.012. Did you see that over there to the left? 0.012. Hope you can. I'm funny. I try to be funny. You are, Cat Millie. Have a nice weekend. Okay. So nice t-shirt as well, don't you think? So that's our profit. Where was I? Yeah, so we used the ATR, so 0.012. So we times what the ATR was by 3, so 0.012. Can you see that there? 0.12. So 0.36 is 0.12 times 3, isn't it? So if we'd got in here at 178.14 and we add 36 to it, basically 0.1, this times 3, we take us to about 117. For what's that? So what I said that was it's here, isn't it? 178.16. So we add 36 to it, takes us to 52. So 178.52 would have been our target. Around about here, 178.52, 17, which is 178.52, which is around about here. So 3 times our ATR would have taken us our profit out there. So we'd have got at it, we would have hit it immediately and got out. Okay, so we'd have got out quicker by using 3 times the ATR on the particular time frame that you're using. So that's the second way of doing it. A third way of doing, which means you stay in the trade a lot longer, is waiting until the slower moving average, i.e. this one is broken, the magenta one, which is not until there. So we give a lot more back and you take it a lot, you're in the trade much longer. I prefer to trade it on the medium moving average, especially I'm trading like 5-minute time frames. I don't have to think now, just wait for the moving average to be broken before we give up. So again, this is just an example of a trending system. So here, that was that long one. This strategy would have gone short here. Let's just complete this on this particular. And again, this just happens to be the Euro New Zealand. It works on all markets, this strategy. And so that was our last sell here. We're going short this time. Our stop loss would be up here. Remember, the turn in the markets, our stop loss is there. Our entry is here this time. Let's just do this for completeness. So, right. So that would have been our short entry. Our stop loss would have been up there initially, because that's the turn in the market. It's only 2 candles back this time, you see. So we got in here. We've moved lower. We've moved lower. We haven't gone back over. Actually, no, we have, didn't we? We went down and then reversed out. So that would have been a losing trade, that one. Okay. However, so we've lost that one. However, the trend is still down, isn't it? So the candles cross back up, but the moving averages haven't, have they? The moving averages are still in alignment, even though they're sloping down. Let me zoom that in and see what I'm saying. So we'd have got in here, we'd have been flat the first day, out of money the second day, nicely in the money on the third day, and we might have even got a target on our ATR if we'd used our ATR, because it's quite a move. That might have 3 times the ATR on that day. It was a bit higher. It was 0.12. So it was 0.124. It's a bit longer. So 0.124 times 3 on that, 178. We wouldn't have quite got to the target. No, we wouldn't have got the target. So we'd have been stopped out there. But this strategy would have then gone short again here, because we've rejected the 20 period moving average, and it's gone short again with the stop loss. Interesting. The stop loss would have been about here, so it might have been stopped out as it's retraced here, this one, to be honest. But let's say on that one, yeah, the turn of the market by re-entering here, a continuation here on the 19th, is still back here. So it's a big stop loss would be the issue because of this big candle that sets out its twist. So no strategy is perfect, and you've got to work with it and manage it. However, the bias is still to the downside because of the size of this candle. So although this would have been quite a big stop loss on this re-entry here, this continuation here, whether we'd left it there, and let's be honest, I may have pulled it down about halfway to the body of this candle on this entry there. So I might have had it there. I might have ignored that, to be honest, and I would have, so I've probably been stopped out on this one, although it's still short. Anyway, that's how to play with it. So it's a very simple trend following strategy, simple entry, simple exit. Either use the ATR of the time frame that you're using, so 3 times the ATR, the stop loss at the turn of the market. Okay, if there's any questions, Kat or anybody else, please let me know, and I will endeavor to explain. Okay, so that's a very simple, stress-free, relatively stress-free, simple moving average strategy. Moving averages work great if the market is trending like we got here. We're going up, or we're going down, or we're going down. But when the market's going sideways, the moving averages are flat. We want a direction. We want a slope. Okay, so they're no good. They keep you out, or they keep you the right side of things. So as we said earlier, this market on my trading strategy, which is a bit related to these moving averages, but it's tweaked a wee bit, is looking to go short again tonight. So that's why we're on this particular asset, wasn't it, Euro New Zealand. So that's the crossing exponential moving average. Okay, it's very simple, very straightforward. Disadvantages. Moving averages are lagging indicators, so they move after the prices happen. Lots of people don't like them because of that. They only work, or they work best in trending markets. If a market is going sideways, consolidating, moving averages are not your friend. You want an angle, so stay out. Have you got the patience to wait, staying out? That's why you wait until they cross. This, here on Trade Locker, you'll get the cross there. You can see there, very clear cross. It happened to cross the 21 as well there. Remember, the blue cross is just the 5 and the 9 crossing here. So that's the cross. There's been a cross there where the 5, in fact, it's a day after because it crossed here, didn't it? But it was also, again, that big down candle also took out the 21 as well. But that blue cross is showing us the day after the 5 and the 9 crossed. So there's no more crosses. So, on this time frame, on this asset, from a trending point of view, as far as the 5 and the 9 moving average is concerned, we're still to the downside, and that is what's happened. Didn't happen instantly, did it? It's taken best part of 2 weeks before we've moved low, and it still might not happen to get new lows here. But that candle's looking pretty positive to the downside, isn't it? Okay, very simple. It's worked well for me over the years on different time frames, and it does all time frames. That's the beauty of it. I like it on the hourly time frame. It's probably the least slowest time frame I use it on. But again, he's a really good example. When you've got nothing happening, although this is so at this point here, this looked quite positive, didn't it? The close of, I said it was right in midnight. Okay, I get the point. Oh, because I called it blank, haven't I? I'll have to rename it in a minute. Anyway, that looks relatively positive, isn't it? Big down candle. We'd had an up run. Thanks very much. It taken us out, looking to go short, but then nothing happened, did it? That one then went long. Nothing really happened, and it hasn't really. Well, they did cross here, but we lost the blue cross there, and now it's gone. But obviously today, it's very, very low volume, so not a lot going on. And this is I'm talking about the Euro New Zealand here. Not the most active of markets. And the other way to look at it is obviously what are the higher time frames doing on the time frame that you're trading it. Okay, so that's the other key thing if you're going to trade on lower time frames. Play it all out. Okay, another one I like. I don't want to lay out. Let's do this one first. Two indicators again. And again, it's a trend following type strategy. One's, again, you've got to follow the rules and wait till we see it. Again, it's a crossing type approach, but one backs up the other. So this is two indicators. One using the MACD, which is the moving average convergence divergence, and by its very nature, it's a trend following indicator. Very powerful. Lots of big strategies. Fund managers have the MACD. Some of them tweak it, have it integrated into lots of their systems. And it's been around for a while, and it's proved its worth many times. It was added to the histogram here on it. Was added about 10 years after the first MACD crossing lines were first put together when the indicator was introduced in the 60s. So MACD, MACD, default setting, again, if we just look at the setting on the indicator, you can change it. So we have two lines, the MACD line itself and the defaulted orange and blue, and then the histograms, the distance between the moving averages on the chart. So the MACD itself and default setting, you see on lots of different platforms, tends to be this setup here. So we have 12, 26, and 9. So the fast moving average, if you like, is set at 12. The slow is 26, and the moving average of the difference between the two is set at 9. The moving average is the difference between the two, which is what the histograms are showing us, is 9 as well. Okay, so what we're looking for with this particular system, so just plug it on, add it to your chart. It comes down as an indicator on all platforms below the chart, not actually on the chart. Like we had the moving average actually on the price action. MACD always sits below the chart, but it makes it easy to sort of correlate to the candle pattern. So what we're looking for here is a cross of the MACD and the signal line. So the last, let's just go back to, what's this? This is Euro New Zealand again. So this one is saying we wait. This is the major crossing. Sorry, this is the major indicator. The two indicators, this is the major one, the MACD. Okay. The other one, let's just go through the other one as well. The other one is the SAR, or the parabolic SAR. SAR stands for stop and reverse. So basically, a system, a strategy of price action has been trending in one direction, but then it's stopped and reversed. It's flipped to the other way. And by its very nature, the SAR, the stop and reverse, can be very choppy. When we've got a trending market, and still, because it reverses and reverses quite aggressively, it can chop you out. The MACD, the beauty of using the MACD, it's smoother because it's a longer time frame and it smooths things out more, and so it takes away some of the choppiness, or quite a bit of the choppiness of the MACD, but of the SAR. But the SAR is a very good trending indicator as well. Some people use it for using it as a level for their stop loss. I think it's usually a bit too far away of the stop loss, catastrophic stop loss I call it, because it's a long way from the price action. So the SAR is plotted on the price action, it's plotted on the chart, and it's either above or below the candles. So when we're below the candles, the blue, and here it's plotted as a blue dot. You can have it as a rectangle. I've seen it as diamond shape. It's up to you how you want it to set. But again, it's just indicators. You're looking for parabolic SAR or SAR. There we are, parabolic SAR. Parabolic is stop and reverse, and then click it on your chart. So again, the settings. Again, you can change them. These are the time increments. Again, you don't need to change them. The style, I've got them as a blue line. You can make them yellow, make them whatever color you want. And whether you put the price on or not, it's up to you. But again, on all charts, again, it's a default indicator. It's another one that's been around a long time. It's great for, I say, trending markers. Again, that's what we're talking about today. 3 trending indicators, and good for that. So basically, what we're looking at, let's chop up. So we're looking for a change in the MACD system. So there's the one before. That's the one before last. So and that's the one. Let's do the last three, shall we? So that's the first one, isn't it? Put in a horizontal line. So you can see the MACD line has crossed the blue line's crossed over above the orange line, and it's looking to be go long. Just before that, let's zoom this up. You can see here the parabolic SAR was negative, but unusually, it's not always the case, but unusually the parabolic SAR is also flipped on this candle here. So as the parabolic SAR, as the MACD line cross, which is the first indicator, the parabolic SAR is already flipped as well at the same time frame. So on this strategy, it's gone long at this point here. And with this strategy, it's a bit more aggressive. The stop loss is again either on the candle that you enter. That's always, I always find it a bit aggressive, or count 2 or 3 candles back. So the stop loss on this one would have been round about there on this one again. And then you stay in the again, it's very easy to stay in this one because you've got to follow the rules. You stay in this one until the parabolic SAR flips. Okay, so this is long, long, long. And as it starts to move up, you could start moving your stop loss up. Again, 3 candles, the lowest low, the 3 candle count back from the current completed candles. So on this candle here, so that's closed back down, having gone up for the first, whatever this is, 2 minutes. It's 2 minutes, yeah, 2 minute chart on that one. So 1, 2, 3 is there, and so your stop loss would be there. Then we've gone up, up, up. So 1, 2, 3. Our stop loss now is here. We've gone up again, so we move up. We've gone up again, so we move up. We went up again, so 1, 2, 3. Actually, it should have been there. So up, didn't really move, but we're still there now. So we went up there, didn't we? So we move up to the bottom of that one. There. So 1, 2, 3 there. Then we had that one. So we didn't. Well, we probably would have been stopped out. Let's be honest, wouldn't we? But you can see what's happened as well. So we'd either been stopped out by our trailing stop loss, or if you didn't want to do it like that, you obviously don't want to leave your stop loss all the way down where you got in. You might moving it up a bit. Wait till the parabolic SAR flips, and the parabolic SAR is flipped from there to there, and we're out. So we're out at the same point anyway. Okay. We don't go short this point though, because with the MACD, as you see at the MACD, you see what's happening with the MACD here. You can see that the whoops. So the parabolic SAR is flipped. But we're still long. Oh, sorry, we've closed our long trade, so we got in here and got out there. So it's another winning trade, but we haven't gone short yet until we get the cross here. The blue cross is below the there. That's the CLE one there, isn't it? So in fact, it would have been there. Well, actually, the first cross would have been about there. So we'd have gone short here because the parabolic SAR is already flipped to above the price action, and then the MACD. I mean, you could wait till there on that candle there where it's clearly short. So we can now get short basically at the entry at the price we closed out our long trade at, didn't we? And that's our second entry on this strategy here. Okay, that's that one there. So we got short there, and you see the parabolic SAR just continues to decline. MACD hasn't crossed, but the parabolic SAR flips at this point. So we get out for our second trade there. So our second trade is made more money than our first trade. You get the point. This is again, another nice, easy to play trending strategy. And if the markets are trending, it's great. So we've had 2 winning trades so far. The MACD hasn't crossed again. So this, look, this one gets us wrong. So the MACD crosses here. So we go long here. But as you can see, it doesn't pan out. So we've gone long. The parabolic SAR is already open, but we go against us. So our stop loss would have been down here, and we get stopped out here. We haven't crossed yet. The blue goes back down. Parabolic SAR goes back up. So we're short again here. So our next one is, so we had a losing trade, but we got a short one there. the MACD is crossed. I should make it the next one. There we are. It's clearly, the blue is now clearly below the orange, isn't it? So we'd have got in here. The parabolic SAR is already flipped. Down we go, down we go, down we go. And then we get a flip to the downside of the parabolic SAR. But it's only for one. But even so, it flips. So the rules is we get out. Or if we've been trailing our stop loss down, it probably waited. We might have still been in it. But the parabolic SAR is flipped. So we get out. However, then the next candle, it flips back again. This is the flippiness of it. The MACD is still down, so we go short again there. So we've had a short trade taken out. We've gone short again here, and then that one flips back, and that's a losing trade because we went short there, and it flipped and got out there. So that was a losing trade. But we've had three or four winning trades, 2 losing trades, and the last position. Which was at 4 minutes past 3, about half an hour ago. It went. We've gone long there, haven't we? As it's flipped out. So as that short closes, we then immediately go long because the parabolic SAR's flipped and the MACD has crossed. Okay, so cross, we're long. What's happened? We flip there, and so we get out there. So it's not a big winner, but it's certainly a winner. And in very thin markets on something like the Euro New Zealand on Black Friday, we're still making money, aren't we, my friends? And that's the beauty of trends. They go on and on and on. So I really like this one. This is courtesy of I call him a friend of mine, a guy who trains the Reuters on the Reuters platform, a guy called Trevor Neal first introduced me to this particular setup, and it's really effective across all time frames. Again, we just demonstrated the crossing moving average on the daily time frame. This is this MACD and parabolic SAR strategy on the 2-minute time frame. And finally, because I've been on for over an hour, sorry, boring the pants off everyone who's still here, or anybody who's here. And then my final very simple moving trending strategy is the Heikin Ashi candles. Now then, Heikin Ashi, it's a different candle pattern. It looks like candles. Let's use a different. Let's use a different asset. Oh no, let's use the same asset. Let's use the same asset. And again, 2 ways of doing this, but I'll go through the simplest way. Heikin Ashi, there's no clear. Let's change the time frame. I don't know. What do we do? We did a daily 2-minute. Let's split the difference. Let's do. I know 30-minute chart. There we are. 30-minute time frame. It's just demonstrating that trending markets happen in all time frames. The higher the time frame, the more significant the trends can be. But trends can go on for a very long time, or not a long time. That sounds a bit of an oxymoron, but that's the case, I'm afraid. So Heikin Ashi means average bar, and that's what you're plotting here. These look like normal candles, however, normal open, high, low, close candles. They're not. They are calculated in a different way, and they use the previous 2 candles to create the open, what looks like the open, the high, the low, the close, and it's the combination of the absolute high, absolute low of the last 2 candles, basically. So, I'm going to the details of it on a proper Heikin Ashi presentation. I've been talking for over an hour already, and I'm and show you some slides on that. If you want some PDFs on all these 3 strategies, I'll let you have them. Just email us, and I'll put some up on the website as well. How to trade with these strategies. But the calculation basically means that the new candle always opens in the middle of the previous candle's price action. Okay, what does that mean? Okay, well, these are obviously red is negative, green is positive in this particular setup. Okay, but it doesn't show the price action like a normal candle. So as you can see, that these previous 2 candles, the high of the previous 2 was here, the low of the previous 2 was here, and the candle has opened. The open of the candle has opened in the middle of the price range, basically. So again, this is opened in the middle of the previous price range here. Sorry, here it's opened, closes down here. This is the low, and this is obviously the high. So what we're looking for with Heikin Ashi candles is candles with big bodied candles, i.e. long bodied candles, like these green ones here or these red ones here, with a wick just to one side, okay? Because the wick or the shadow of the candle measures rejection, as it does with normal candle patterns. So if we're going to go long, we need a big bodied green candle with no wick to the south, okay? So trending upwards. So this is a positive position to get in. You know, it closed here. It went from red to green. That's also positive. This is a positive. See how this is pitched? This is a good example of Heikin Ashi candles. So this is a good example of going from one trend, the trend switching very quickly in the space of a candle, in the space of half an hour. So it's been short positively. You'd have got in there, then it's gone short, and you've been stopped out because it's suddenly turned to go long. But that long trend has gone on for 1, 2, 3, 4 more candles, 5 more candles before it starts to show question mark, and then it get out here when it goes turns to red. Let me just explain that again. So let me say that again. So to go long or to go short, because it's a trending strategy, the bigger the body of the candle, the stronger the signal. Okay, no wick is the strongest signal of all. Let's see, there's a very small wick on that one. Oops. Very small. Can't remember where it was now. It was there, wasn't it? Very small wick on that one, but you still get in here. 1, 2, 3, 4 followed up. Out potentially on that one, but it's still green. So if you're being aggressive, you would have stayed in. Flip to red, you got out. Got short on that, but it's a very weak short because the body of the candle is very small. There's no wick to the north of the of this particular red candle, and then we get a doji candle, and then it goes green. So that was a short, didn't work out, but it's no wick. It's a small body candle, but it's enough to get in. There's a suggestion that it may not be as strong on the next candle because there's a wick to the south. We don't want any wicks to the south, but then the next 3, 4 candles are good and green. There's a lot of indecision on the following candle, but it remains green. We go down to here, we go up to here, but we're still in it, still green, and then we finally get out here when it changes to red. We then go short because there's no wicks here, no wick, no wick. Smaller, but next candle, we've had a nice little run down here for an hour or so. Next candle, suggesting we may want to sort of scale out of our position. This is a good one for scaling in, scaling out of position as well. Heikin Ashi candles, using it, just simple color change here. And there's also a wick to the north as well as the south. That's what we want to see. But then finally we flip and we get out on that one. Go long here because there's no wick, no wick, no wick. That one, the wick, you see the wick to the south is just very small, so it might be suggesting to start to get out. The body of the candles is also suggesting that we started aggressively, but you see how the bodies of the candles have got smaller each time, so that suggests this move might not be happening. Then we get out, then we go short, but that's red, but there's indecision red, so it's that hasn't worked out, that hasn't worked out. That's not a strong enough signal to get in, really. Unfortunately, this is another example where it doesn't work. It's gone from green to red, but there's wicks to the north. Wicks to the north is not a big candle. This is getting positive because this body is bigger than that one. That body is about the same size as that. That's a big positive one. However, it only lasted for one candle, didn't it? So that failed. So we'd have got in here and got stopped out here as it's gone to green. So it's quite a big losing candle, but then that one wins, doesn't it? So you get the point, basically. And again, you can play it how you want to. At the moment, let's bring it right up to date. At the moment, this is a big, strong downtrend. We're going sideways here. We're going from red to green, wicks to the north and the south stay out. Wicks to the south get short out because it went to green, get long because there's no wick to the south. You see how it's chopping around? Yeah. The beauty of Heikin Ashi, though, is when you've got a very strong trend. If I just bring up a different asset, because actually this is, it keeps you in. You don't have to think about getting out or not. Some other assets might have been chopping around even more, but this has been very much short. Remember, this is the one we were talking about potentially going short on the daily time frame today, didn't we? The Euro New Zealand, I think, on my end of day strategy, wasn't it? So the end of day strategy went short yesterday, weekly, a week short. When I say weekly, there was a strong long there if you'd been chopping from green to red, but it's short already on the Heikin Ashi, and it's look the normal candlestick. My system is triggering to go short today. So the rules of the Heikin Ashi, very simple, a bit like the MACD and the parabolic SARs and the moving averages. Candle color change. So again, to set it up on your chart, you just look for Heikin Ashi. So it's Heikin Ashi, spelled H-E-K, Heikin, Heikin, Heikin Ashi. I'll spot it wrong. It's fine. Unless it just have its, did it have its high? No. Oh, it's not. Sorry, we're talking about. It's not an indicator. Sorry, it's a candle pattern, isn't it? It's on the candle pattern. So on the candle pattern, sorry, set up different here. It's set as a type of candle display, because it's a display rather than indicator in trading view speak. So it's here. So this is a different way of showing your candles. These are all standard. So again, you can change it to a bar, simple line, the average of the price over time, or it's Heikin Ashi, and that uses the Heikin Ashi calculation. So it's not a normal candle which showing high, the open, close, high, low of the time frame. It's using a weighted average of the two previous candles to plot, or the current candle and the previous candle to plot the current candle. That makes sense. The highs, the ultimate highs, the ultimate lows, and the mid price of those two, and then half the average of the high, open and low prices as well to plot the Heikin Ashi candle. So it smooths out any differences. So let me see. I'll demonstrate that because it's a candle, I can't overlay it. So that's the Heikin Ashi candles. If I just put a normal candlestick on there, see if they cut. Yeah. So this is a normal candlestick where we've got three. We got green, green, red, red, red. We got the Heikin Ashi. I think it's probably the same. Green, green, red, red. But you can see the candles are in a different position because it's the average. It's smoothing out of the move. Okay, so this is looking to go short. So so the rules of entering the Heikin Ashi, same as before. So again, nice strong downtrend. That would have been a strong entry because there's no wick to the south. That would have been a strong entry. And then if the body of the candle is still strong, you could have added to it there and added to the position there because it's a strong move, strong move, strong move. I mean, you could add it to 1, 2, 3, 4, 5 times as that trend is going. We've burst to new highs. That down leg's been taken out, but then at the following candle, we immediately cool. So you could have reduced your position quite significantly because it's a very significant change in trend, isn't it? Or change in tone of the market. Very small candle body. The wick, the volatility is, the distance traveled is less. We haven't got to new highs like we had in the last previous 4 or 5 candles as we've got here. So the trend's gone up, we come down, but we're still green. So we stay in. We don't get rid of everything because it could have then gone back up. We get out completely when we go red. And we go red and we're indecisive because we're a sort of a small doji type candle. Wicks to the north and south of the candle, wicks to the north and south of the candle. Same here, although it's flipped to green this time. It's not strong enough to get in. Stay out, stay out, stay out. You might have got in on there on a bigger bodied green candle, but certainly you would have got in there on the no wick green candle. So it's a very simple strategy to apply. It works better on the higher time frames because of the price action is quite away from the candle pattern because of the way the nothing's perfect because of the way the calculation works. Hopefully you can see that here. This is the spread. Is that the spread or is it? No, hang on a minute. Where's the? Yeah, that's the current price, bid and ask price on this particular asset. I mean, I've used a bad example, Euro and New Zealand, but as you can see, the price is away from the candle. Okay, so the actual cash price, if I go back to a normal candle, let's just see that. No, go back to a normal. Oops. or even a normal bar candle. You see the price now is within the bar of the candle. Let's go back to, sorry, let me go back to a normal candle around the bar. The price is there. Okay, with the Heikin Ashi candle, see where the price difference is because of the way the calculation works. Okay, so they look like normal candles, but they're not. So just bear that in mind as well. You know, so simple way of just using the color change to use Heikin Ashi. Another way is to use the ATR. Again, default ATR set at 14 periods, and use a multiple of the ATR to create your target levels. I mean, people use it just because of the color change. It's simple, just, you know, all of this really, really simply, because you're just looking for a code change. And as you can see, when it does go, it can go really strongly, like we got here and here, less so going down. So strong up moves, nothing going on here. So you stay out, get in, maybe get in, maybe get out, but less move, not much going on. But this is because it's, you know, it's the daily time frame. Actually, that's the daily time frame. So, very much a sideways action. This is a trend following strategy, so it's saying there isn't a big strong trend here. Literally the second half of November for Euro New Zealand. Yeah, I mean, if we use it on an asset such as, you know, if we use it on an asset like gold, you can see the strong, or even an index. Let's finish with, oh, let's finish with gold. Let's use this one for a change. On the Heikin Ashi bars, you can see this strong move down we had ahead of the election. There's election day, the 6th, big old move down. So trend, stay short, go long here on the 18th, massive move, and that's the shakeout we had on Monday, Tuesday, Wednesday, Thursday, Friday. See, interestingly, see how the Heikin Ashi candle, because this was still a strong trend, although this was a big red down candle on a normal candle setup. That's why it's, you know, it took until the following day before it went properly negative. So it was negative for 3 days, big negative day, against, and it's bounced back up again today. So that short there for Heikin Ashi traders hasn't played out, and you would have been. It looks like you're going to be out today as we're moving back up. Normal candlesticks, similar sort of setup, wasn't it? And down we went. Down we went on Monday, and we've recovered Tuesday, Wednesday, and Friday looking like a good day. 26.50. We're just 26.54. We're just having to go at as I speak. So there we go. Have a great weekend, everyone. 3 simple trend following strategies that work. They work well enough. When I say they work well enough, what does that mean? Well, they win about 60% of the time. They lose 40% of the time. And that's the key, my friends. Being able to deal with that 40% of the time when you lose, or the 35% of the time when you lose, or the, you know, even the 20% of the time when you lose. You've got really good strategies win 80% of the time. There are many strategies that win a lot. You see it all the time over the internet. But do those traders, you know, have they got the longevity? Have they got are they still in the market in years to come? Have they hung on to those winning strategies? Quite often, you know, those that win too much end up giving it all back. You know, you need a strategy that works for you. It works with your psychology. It works with you as a person. It works on the time frame that you're comfortable with trading. That's what makes the difference. We've got to control our fear and our greed, and, you know, bag your winners, accept your losers. Many people can't do that, and find it very difficult to lose. It's just part and parcel of this game that we call trading. Other than that, it's quite simple. Well, it's the strategies are very simple. The approach can be very simple. Don't overcomplicate it. But the problem is, we're talking about money. We get very emotive. We get very emotional. We get too uptight about it. Manage yourself, and you can be successful at this game. Okay, I've talked for an hour and a half, far too long, but there we go. 3 strategies on Black Friday for you, free of charge from your good self, well, yours truly. Have a great weekend, everyone. Stay safe. See you all Monday. Monday, we got a new month. Really positive month, typically December for stock markets. Let's see how we happen. We've had a good run so far, October, November. How are we going to run into the end of the year positive as well for stocks? Where will gold go? Will we get back to all-time highs? Will we go back to 2,600? We'll see. 2,500? We'll see. Bitcoin looks like, 100,000 inevitable in December. Surely. All right. Take care, everyone. See you soon. All the best. Bye-bye.